Today, the power of pretend. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post carrying finance and problem news with a distinctively Australian flavour. Today I'm joined by journalist Tarric Brooker. Hi Tarric.
G'day Martin, how are you?
I'm hanging in. That's about the best I can say, I think. How about you?
Well, I think that's pretty much all ever anyone can sit in Sydney can do at the moment. But, hopefully in the not too distant future we'll be out of it and we would have gotten through all this.
Well, it's interesting, isn't it? Certainly the virus is raging and the controls are becoming ever tighter, but the numbers aren't going in the right direction yet.
No, they're not. And I think that it's a very difficult thing to quantify at this point, to be honest, because we've got this situation now whereby we've never really suppressed an outbreak to zero from this size of the Delta variant. And really, like, even just looking at the states at the moment, they're even talking about potentially reimposing some lockdowns, and they're far, far, far along the vaccine path from where we are.
Yes, and it is interesting. There's some people saying, well, maybe there's a change of language being to happen. They're not so much talking about cases; they're talking about, hospitalizations and deaths. It's what they're doing in the UK now, having got a certain level of coverage via the vaccines. And, some of the indicators are still looking pretty negative, but the death rate is a lot lower. But it's an interesting variation on a theme, because basically what they're putting all of their eggs now on is vaccination, 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 isn't it?
That is what they're putting it all on. But I think that so far what we've seen around the world is, well, shall we say, inconsistent. You look at the UK, case numbers are thankfully coming down, but you wonder why is that the case in the UK and not elsewhere? That's equally well vaccinated. Why is it that Israel is reimposing some restrictions and talking about a third round booster shot for the elderly? Why is it that in America the number of cases is continuing to head ever higher despite higher vaccination rates? So I think that it's really hard to come out and just unequivocally say this is what's happening, this is where things are going, and this is our way out of it, because we've done that so many times before and then we've left people disappointed. And I don't know, I mean, looking at all these people on the streets protesting, it makes you wonder how many more times we can keep doing that, how many times we can promise a return to normal. And I'm not just saying here in Australia but around the world.
Well, it is interesting, and the IMF came out this week with their latest update, and they sort of waffled on a bit about, well, overall growth won't be very far from where they thought, but they talked about the difference between the areas with higher vaccine and lower vaccine, and the fact that until this is globally stamped down on, no one is safe because we're likely to get more variants. I think there should be greater transparency about the uncertainty. What I think we keep looking for is for politicians to be definitive and certain about things when they can't be.
Yes.
And the truth is that there are so many variables and so many uncertainties that unfortunately is the reality of where we are. But I personally would give much greater weight to those in power if they would acknowledge that level of uncertainty, rather than keep kicking the posts forward and say, well, we've got a new goalpost or a new target or a new way of, it's like, eventually cry wolf so many times that you just then give up.
Well, I mean, we already may be there already at this point with the way things are going. And, people have been going through this now for almost 18 months. And it's getting increasingly hard to get people to be compliant with it. And, for better or worse. And as you say, the problem is that I think we're in the minority in that respect, in the sense that we just want the truth. We just want the unvarnished, unblemished reality of the situation, warts and all. But that's not what a lot of people want. They want a promise of a path out of this, because they're not prepared to hear, oh, this could go on for 12, 18 months, years even, especially after they've gone through what they've gone through already. And I mean, that is unfortunately just the way it is. And to be honest, one thing that annoys me quite a lot when I watch some of these press conferences is the journalists fishing for a gotcha moment with Scott Morrison or Gladys Berejiklian, and they're all just like, oh, when is this going to be over? When is, and they give these questions that are just designed to give you that gotcha moment, or for them to finally be put on the spot where they go, I don't know. like John Barilaro was with Karl Stefanovic. I'm not going to say that Karl Stefanovic put John Barilaro on the spot. He didn't. But that is the sort of response that they are fishing for.
Yeah. And look, if you talk to the scientists and listen to what they say, they talk about probabilities and levels of certainty and levels of uncertainty, and they're doing modelling at the moment. And the Dow Institute had to say, look, we've had to recraft our modelling because the Delta variant is behaving very differently from the earlier ones. So, the truth is that there are so many uncertainties here. But then, as you say, the mainstream just want that hook moment. They want to try and trip somebody up rather than actually spread light, so that people have greater understanding of precisely where we are, and then, expect somehow magically we're going to pluck the solution out from somewhere and ta-da, it's all fixed. That is not the reality that I see.
The problem is that we're having sort of a reverse of like the Dunkirk moment during World War II. Like whereby instead of having Churchill coming out and saying we don't win the war by evacuations and ramming home exactly what the odds were for the British people fighting alone against the Axis powers at that point, we've got governments continuing to come out with all of these promises. Scott Morrison says that everything's going to be right by Christmas, and there's no guarantee of that. I mean, look, we all hope it's true. Lockdown is not fun for anybody. But by the same token, what are we going to, what are things going to look like? What are our streets going to look like in January if there's a new strain or if the vaccine hasn't proven as successful as we'd like, and things are still the way they are today? It's not pretty, and that's not how you run a country during a crisis. There needs to be a certain amount of honesty.
And look, I've got this perspective, I don't know whether you share it, but if you actually are an expert at spin and marketing, right, then you're going to be dodging and diving and weaving and trying to find a story that you can tell. But sometimes honesty, and by the way, saying sorry properly, right, would actually give you more credibility and more ability to effectively communicate with a broader community than just trying to find another spin story.
It would, but the reality is that you need that type of personality, that type of character in order to deliver that sort of leadership. And whether or not Scott Morrison is capable of that, I don't know. I don't know the guy well enough, but from what we've seen so far, that kind of, apologetic nature and that kind of unvarnished truth seems rather unlikely, especially considering, his recent statements. I mean, he said Christmas now. He said last year that all the Aussie stranded overseas would be home by Christmas, and that hasn't happened. So, I mean, I'm not putting much stock in any of it, to be completely honest with you. I just, my magic 8-ball's clouded, and I'm just gonna, just accept the uncertainty until it clears.
But there's a little secret here. Christmas comes once a year, every year, right? He didn't say which Christmas.
Oh God, wouldn't that be perfect? That'd be ammo galore for Labor, wouldn't it?
It certainly would. Well, let's try and delve into some other areas of certainty or uncertainty. So Jerome Powell came out this week with the press conference statement, that basically, well, didn't do much. Basically, we're now thinking about and talking about tapering, but we're not going to taper yet, right? And there's still a ways to go, to quote to quote him, right? But I thought it was quite interesting that they've reactivated the repos that they put to sleep some time ago, right? Which to me is a sign of the fact that the total financial system plumbing is still not where it should be.
Well, pretty much. I mean, if you look into the documentation on that, you're talking about a $500 billion overnight repo facility for domestic US banks and financial institutions, and then you've got another $60 billion ahead for foreign. I assume it's for foreign nationals, so it's for foreign governments who are in need of dollars. And I mean, Jesus, we've got to a point now where you're talking about doing more intervention in the repo market overnight than the entirety of like an entire QE program after the financial crisis. And the reality is that it's not fixing anything. We just keep papering over the cracks and papering over the cracks. And you know what it's like? It's like fixing a broken old car. You fix one thing, and it's like, yes, fantastic, I fixed it. And then you throw a little bit more power through it, and you're like, oh crap, I've broken something even bigger and even worse, and now it's an even bigger problem. And that's exactly what we're doing now with the Fed. And all you have to do is look at something like Chinese government bond yields, and it's like, oh wow, clearly things are not fantastic.
No, and I don't know whether you came across that report from the House of Lords in the UK, but they published this amazing report called Quantitative Easing, a Dangerous Addiction, right? And a number of very significant luminaries were involved in that, including the guy who used to run the Bank of England back in 2008 and who invented quantitative easing. So he's now saying, well, it worked for a little while, but it's not working now. And interestingly, their whole thesis is that the Bank of England has no exit strategy for quantitative easing. It's more about keeping funding costs down for government borrowing. And interestingly, both the Bank of England and the UK Treasury didn't really cooperate with their inquiry, but there will be debate in the Houses of Parliament because of this report. It is worth reading. It's probably one of the most sobering pieces of work that I've read.
Well, I've read the summary. I haven't read the report in its entirety, but it's not really all that surprising, to be completely honest with you. Unfortunately, it's just one of those it is what it is sort of things, because they are keeping their foot. Well, they've got the brick on the accelerator of the QE pedal. I mean, here in Australia, the RBA, the RBA is reportedly going to go towards $6 billion worth of bond purchases a week. So, they're going to own the whole bond market, by the time the next Olympics comes around at this rate. And it's ridiculous, because there is so little evidence that it provides any real assistance to the real economy. And there's so much evidence that says that it doesn't, and that it just distorts things horribly, inflates asset prices, creates all sorts of problems. Now, I know that there's this debate on QE regarding whether or not it's actually doing it literally or whether it's doing it because of psychology. But I would frankly suggest that it doesn't really matter. What's happening is happening as a result, cause, effect, how exactly that happens, whether it's through psychology or whether it's through market plumbing, doesn't really matter. But it's just a ridiculous set of circumstances that they continue to do this, that they continue to blow these bubbles and lower rates and do all these things to the point where basically most households in a lot of different countries who've purchased a family home recently are completely stuffed if if interest rates ever return to their sort of long run average. I mean, can you imagine a cash rate here in Australia of like 5.5%? It'd just be like, you'd see heads exploding everywhere as home buyers, attempt to grapple with the reality of that new situation.
That's true, and I think there's no chance that they will be able to put rates up that high, even if some of the international markets move in a different direction, because if they did, then that would be the collapse of the property market. It would also be the collapse potentially of the banking system as well, right? Because so much of the banking system is leveraged into this. And by the way, APRA has now come out and confirmed that the banks can now not count any bad loans, thanks when they've postponed the repayments. They don't have to count them in the bad loans bucket, although they have to do a bit of provisioning and things. But, we are in this really, really weird situation where, the definition of insanity is doing the same thing and expecting a different outcome. Well, with quantitative easing, they're doing the same thing. They're expecting a different outcome.
Well, in a way, it's actually a lot worse, because it's not doing the same thing. It's doing more and more and more of the same thing and expecting a different outcome.
Yeah.
And I mean, let's be honest, they're not that stupid. I mean, I'd like to think that they were, and this is all just a case of incompetence over malice. But I mean, let's be honest. At this point, I think it's fairly clear that they know exactly what they're doing, that they know exactly what the consequences are. It doesn't take a rocket scientist to see what's going on. And I mean, as you always say, this is leading us down a dead-end street. There is no way out of this. And I mean, previously it was we can't normalize to 2008 level rates. Then it was we can't normalize to 2012, 2013 level rates. A couple of years ago it was we can't normalize to 2016 level rates. And now it's we can't normalize to pre-COVID level rates. I mean, I'm not sure if you heard, you saw Deutsche come out recently. And they said if we see positive real real US bond yields. So basically things are just going to completely blow up, and that's the end of the whole shebang. So, I mean, what do you do?
Well, you do more quantitative easing, and you keep talking the market up and assuring them you know what you're doing, even if you're not quite sure quietly whether you do know what you're doing. So there's no real rhyme or reason other than just pumping and pumping and pumping and hoping, right? That's where we are at the moment.
It is, and I mean that's where we're stuck. And the thing that really gets me about all this is I read these, say for example CBA's recent report. They said it's going to hit the Sydney lockdown is going to hit the Australian economy for about 2.7% of GDP. No, sorry, it's going to the GDP in the third quarter is going to decline by 2.7%, I should say. And I just feel like saying to them, it's like you guys do realize that this is happening all over the developing world. And not only that, but increasingly all over the world in general. You look at Japan, you look at Korea, you look at all these different places being impacted by the virus. And I mean, even the US could head back into lockdown. We just don't know. It's a possibility. And the reality is I just feel like sometimes, like, how do you think that these countries in the developing world are going to be able to get through this? That everything's just going to be hunky freaking dory? It's not, and it just really boggles my mind. It's like, if it's going to lop that much off of our GDP here in Australia, what do you think it's going to do in these countries that don't have JobKeeper, that don't have Scott Morrison raining money down from the sky for all the little good boys and girls? It doesn't make any sense to me, to be completely honest with you. This is gonna cause all sorts of problems, and that's one thing that really bothers me about the QE. And even some of the fiscal policy as well. They're just throwing all this money at the problem with absolutely no regard for the problems that it's creating around the world.
No, that's right. And interestingly, of course, the reverse repo market in the US is now up to $1 trillion, right? So more money is flowing back to the Fed there. And here we've got equivalent with more than the term funding facility in it. So, all of this liquidity is sloshing around the place, and the bank's throwing it back at the central bank because they don't know what to do with it. It's not going in the right place. It's not driving real economic outcomes.
No, it's not, and that's part of the reason why. Like, don't get me wrong. Right now, I'm very much in the stagflationary, camp, and if in the short to medium term, because how are you going to fix all these things? How are you going to fix all these broken supply chains that are being even impacted today as a result of COVID in China or Japan or Korea or any number of other places? These things are not easily or swiftly fixed. But by the same token, the lack of investment in the future, the lack of productive investment, the lack of business lending, the lack of even just investment in actual genuine infrastructure, not the crap that a bunch of politicians get together in America and call infrastructure. It's all those things lead to positivity, and if you get enough of it, you get inflation. But without continued government intervention, which, let's face it, may end up happening, and this is a moot conversation to begin with, but if you take that away, you get disinflation or deflation, and that's just the way of things. But the question is are they going to be willing to take away the punch bowl?
Well, I can't see they will at the moment. Now, I feel some slides coming on.
Well, as you can see, we've got a nice little cartoon there with stagflation sticking around.
That is so brilliant.
Yeah, I love that one. Okay, well, we got the CPI report this week for Australia, and well, it's 3.8% year-on-year inflation. But if you actually get drilled down to the nitty-gritty inside the CPI, well, let's just say it's not representative of the real world. According to the CPI, rents rose by a grand factor of 0% year-on-year, and that's quite different to what a lot of you are no doubt experiencing in, well, real life. If you have a look at SQM's weekly asking rents index, the 12-month change on house rent is up 15.4%. Units are up 8.7%. Now, I should say that this is asking rents. This isn't actual rents. So it is obviously, not a perfect comparison. However, SQM's methodology suggests that this covers about 97% of the Australian housing market. So even if you sort of allow for differences in methodology, differences in makeup, differences in how they approach things, the gulf is still enormous. And frankly, it's really something telling people whose rents are skyrocketing that their rents aren't skyrocketing you know. And I think that this is going to increasingly become a problem with how CPIs are weighted and how things are assessed in terms of how people in the real world are seeing things and how things are being seen by government.
Yeah, and of course, all this debate was about transitory versus not. Powell was on about that this week, right, and arguing, well, this is a one-off rise in prices. It's not necessarily continuing. But all of my surveys suggest that real households have cost of living that are rising much, much faster than the CPI. And, this really proves it again, that the official statistics don't have much relationship to real life.
Yeah, and I would also add to that at the end of the day, the actual statistics in terms of like what they are in reality, that doesn't matter either, because at the end of the day, what matters is people's perception of things. If they think the cost of living is skyrocketing, they're going to adjust their spending accordingly.
No, you're right about that. And we're already seeing, of course, some, a lot of households with very little free cash, even more now with all the lockdowns. And so that's one of the reasons why incomes have been flat for so long versus costs going up. That creates compression.
Absolutely. Well, this is a perfect example. If you look at the weighting inside the CPI basket, the combination of alcohol and tobacco are weighted more heavily than rents, and for reasons that no reasonable person really understands, the cost of housing in terms of owner-occupied housing isn't actually included. Only new home purchases are. So you have this situation where there are households out there who don't consume alcohol, who don't consume tobacco, who rent, who aren't really being represented by the CPI in any form of accurate way. And at the end of, and not only that, but despite some households spending 30, 35, 40% of their income on rent in a lot of our more expensive capital cities, the rents are only weighted to being about 7% of the CPI.
Yeah, and it's worth just unscoring. This is an area chart for each of the elements within the basket of goods, right?
Mm-hmm.
That's why this is so powerful. And what that shows you is that the representative weightings of different elements are just so off key. And look, many people will be surprised, I think, that housing costs aren't included. And that was a decision taken by the Reserve Bank some time ago. And they use this sort of rental proxy, right? And so if the rents haven't gone up, then there's no cost of increase in housing. Now, and I know, cost of housing have gone up dramatically.
Yeah, exactly. It's also the fact that the CPI can also be, well, this is more related to the US in terms of how things are weighted there, but they can be distorted by large moves, say like the move in lumber and also the move in used cars in America, where prices have gone through the roof. It's now got to the point where if you have a used car that's 1 year old here in the here and now, and a lot of times you can go onto the dealer lot and order a brand new one that's going to take several months or a year or two to get, and sell them the one that you've already bought for more than what you paid for it in the first place. But the problem is, as these trends reverse, you're going to start to see this drag on the CPI significantly. And if it reverses very, very quickly, it's even possible that you could end up seeing short-term deflation rather than inflation, even though the cost of living in a lot of other things is actually rising.
Yeah, and that's significant. Again, Powell specifically mentioned used cars as one of those temporary things that actually have influenced the US numbers, and of course they've influenced the Australian numbers too. But this again shows you the fallacy of the basis of the calculation, really, doesn't it?
Well, it does. I mean, how many times is the average household going to be buying a used car? Realistically, a lot of households buy new. A lot of households don't have cars. So it's this real sort of interesting conundrum whereby, yes, obviously you need to measure it, but you're going to end up with this incredible distortion both on the way up and on the way down, which is why, I mean, it's entirely possible that we could see absolutely horrific inflation in things like food, energy, cost of housing, all these different things, particularly in the US. But it may not show up in the CPI in the same way that people in reality are actually feeling it.
Well, that's true of food in Australia. So in my surveys, the costs of food are very, very significantly represented in it's got a lot worse than 12 months ago. But in fact, the CPI numbers weren't that dramatic for this time around. So again, it just shows you the disconnect.
Absolutely. This takes us to China. Now, China has been in the news a lot lately with them taking a stab at their they're taking a stab at a lot of things: the tech sector, the education sector, even at housing. In Shenzhen, the median house price has dropped 15% in the last 6 months. Now, you can call that a crash or you can call that a correction or whatever it is, but the difference between a normal 15% drop in housing and what's going on in China is that it's been very, very deliberately targeted to do so. Now, whether the Chinese government has targeted it for the purposes of attempting to stabilize prices or whether it's deliberately trying to bring them down a little bit, well, personally, I lean towards them trying to stabilize prices, but the problem is you can't stabilize a bubble. So there's this really interesting thing going on in China where they're trying to address all these issues with systemic stability, but at the same time, the more they interfere, the more likely it becomes that they create a problem. Now, as China sort of continues to ease off the accelerator in terms of their borrowing and stimulus, you were starting to see lower growth being priced in, lower inflation priced into Chinese government bonds. And despite the vaccine and everything else and all these trillions of dollars worth of retail-driven stimulus in the US flowing through, Chinese bond yields are where they are last June, long before all this stuff with all the vaccine, with all the stimulus and everything. So I think that really speaks volumes about where the world is heading more broadly in a sort of not as manipulated market indicator rather than US bonds, which are admittedly a handy indicator, but still heavily distorted by the Fed's intervention.
Yeah, it is interesting. And it's also interesting how the announcements with regard to clamping down on, for example, the training and education sector flowed over into the NASDAQ as well, with listed stocks from China in the US actually taking a significant bath and driving the whole index down.
Indeed. And it's a similar. This is one as I quite like because in the US, junk bond yields are currently at record lows. So actually, junk bond yields are actually negative yielding in real terms, which has never happened before in history, mostly because it's positively idiotic. The idea that a company is so safe that you can accept a sub-inflation yield on it is just frankly ridiculous. But that's what the Fed's done. And if you look at the Chinese high yield bond yields, or AKA junk bond yields, they're rising significantly. They're out there at the highest level since April last year when, everything was hitting the fan in China. And they continue to rise despite the Chinese government's jawboning and intervention and everything else. They are pricing trouble ahead. And it does make you think about what will eventually happen when the Fed is overwhelmed by things going wrong around the world. And the issues of, as you say, issues in the Chinese market, in Asian markets in particular, spilling over into Europe and then into the US.
Yes, and it is again interesting that in China the banks have been given more leeway with regard to reductions in capital ratios to try and stabilize the ship too.
Indeed, and I think that that's really just window dressing. Realistically, I mean, they're not going to lend more. The tightness. The small businesses, medium businesses have commented on the tightness of credit in China, and the banks are, I think, rightly concerned about the long-term growth prospects of small and medium enterprise in China because they don't enjoy the same level of support as the state-owned enterprises and the real big boys who can, write these big offshore bonds.
Absolutely, that's exactly right. And so the banking system is definitely under some strain. And of course, the momentum in construction in China is also off a bit too, isn't it?
Yeah, it is. It is indeed. I'm actually going to be getting to that a little bit later, but this is, as Martin was discussing, Chinese stocks are starting to get hit quite hard and are not really all that far off where they were when the pandemic began. Only a couple of 100 points on the Chinese A50. And I think this really speaks volumes about where things are going because between sort of mid to late March and around about sort of late February, this relatively strongly tracked the performance of US stocks. not of the S&P and the Nasdaq, but just of US stocks more broadly. But since February, which is also when Chinese bond yields peaked, it's pricing in just more challenging times and just weaker growth. And this is obviously despite all the efforts of the Chinese government to inject various fiscal and monetary stimulus.
In fact, of course, if you were to lay that against the US indices, right, completely different trajectory.
Well, absolutely, it's the same. It's the same thing across the board. It's the same if you put US high yield credit against Chinese high yield credit, they're diverging. It's these big alligator jaws of doom. That people love on these charts, and they're just completely opposite. And the reality is that China is the engine of growth in the global economy, and as we saw last night in the States with their GDP coming in much, much weaker than expected, I don't think America can be relied upon to drive global growth.
And it's interesting because the way that was reported superficially was a very strong result, right? But way lower than what the expectation was.
Well, I mean, the miss. I mean, I don't know what level of sigma miss it was. I haven't seen or done an analysis, but it was huge. I mean, they were expecting 8.5%. They got 6.4, 6.5. It was a 2 percentage point miss on something that large is just huge, and it also, everyone just keeps saying, oh, it's inventories. And it's like, yes, it is inventories, absolutely. But until the supply chain issues are resolved, inventories are not going to recover, not to the degree that you would like. So, I mean, they're even talking about in the US of there not being enough school books and pens and school bags for kids to go back to school. I mean, it's becoming a rather significant issue. I mean, they're talking about running out of like tomato sauce and chicken nuggets and all sorts of crazy stuff.
Well, if they run out of chicken nuggets and tomato sauce, the world is over.
I should say ketchup. Sorry, but I don't want to get it right.
Yeah, but again, the interesting story here, of course, is also that the new unemployed was actually higher than they expected to on Friday's numbers.
Yeah, and I believe that's the 5th week in a row it's been higher than expected, and they keep it. I think it's funny, when it comes to stocks, it's always these estimates that end up being, relatively, well, shall we say, I'm not going to say pessimistic, but relatively, realistic with a hint to the downside. But then when it comes to them forecasting things like employment, they just keep getting them wrong. And I think that really speaks volumes about the sort of real US economy, in the sense that, 44% of small businesses are still closed. 27% of low-income earners who lost a job haven't got it back. And, I think there's two very different Americas going on, but I think that's true everywhere.
Yeah, well, I think we've talked about the K before, right? The upper and the lower leg of the K. Some parts doing well, but a lot not. And unfortunately, the lot that are not are actually getting even more hit.
Yeah, indeed. Oh, this one matters quite a lot for Australia. In the last, not even in just the last few weeks, we've seen Chinese steel mill profitability just fall off a cliff. In the worst way since 2016, since where it was in 2016, and this is really quite key for Australia because this could really impact the price of iron ore, which could impact the federal budget, and also just headline GDP more broadly. Because if we do see a large drop in the price of iron ore, particularly in the fourth quarter, that could be a trigger for a technical recession. Because we've got Sydney in lockdown throughout Q3, and if it lasts as long as the CBA are talking about, which is sometime in November, coming out of lockdown, and then you have iron ore coming off the boil at exactly the same time, especially if it ends up being a rather large drop, that could be a trigger for a technical recession here in Australia. And we've already seen the Dalian iron ore futures in China come off about, when I checked before this recording, it was down about 6 or 7% in China.
Yeah, and it's interesting because, of course, the Treasury keep forecasting lower iron ore prices and then get surprised on the upside. It'd be pretty disastrous if now they start forecasting upside and we get downside instead.
Well, In terms of the budget, they're still likely to be a surprise to the upside because they're only assuming a price of about $55 a ton. So unless iron ore absolutely just falls off one of the largest cliffs in financial history, we should be okay in that respect. But it's still going to hit the terms of trade, and it's still going to hit the budget bottom line more broadly, particularly now with Sydney in lockdown, and also just the fact that it's just going to be bad for headline GDP.
Yeah, and of course, my theory has always been that's one of the little sort of hollow logs that the Treasury has used, so that they can justify that their predictions were actually close to the truth, even if the composition's different.
Yeah, indeed. And despite the fact that China has seen record levels of steel production this year, we've actually seen it fall significantly as the profitability of steel mills has fallen. So this presents a rather interesting picture for China because she and the Chinese government are concerned about inflation. It isn't, people talk about deflation. Historically, in the last century, it's inflation that destroys countries, that blows up governments, and ends up with, leaders being removed from power, shall we say? And it's usually not done very nicely, but that really presents the problem for China because if they want to put the foot back on the accelerator in terms of stimulus, that's going to mean higher iron ore prices. It's going to mean higher commodity prices, higher copper, higher all these different bulk commodities that they need for their construction-driven growth. But by the same token, by doing that, they're just going to create higher commodity prices, and that's something that they're trying to address right now by releasing state-owned reserves into the market to put downward pressure on prices.
Very interesting and concerning in terms of what that could flow through to.
Absolutely. And this is a chart of the Chinese credit impulse versus Chinese government bond yields, and as you can see, there's a fairly sort of substantial relationship between the two, and I think that this is what we're starting to see now, except I think we may see it rather than it being so significantly lagged as it has in the past, I think we may see it accelerating more significantly now. Because for all of the big numbers coming out of China, for the big headline GDP growth numbers, or whatever it is that they're spruiking this week, the reality for China is that the recovery for small businesses and for households hasn't been anywhere near as strong as they would have liked. And that's forcing them to lean on the traditional levers of growth like construction much, much more than a lot of the Chinese government would have preferred. So there is that concern about inflation, and that's part of what we were discussing before, in the sense that China is now having to deal with the consequences of all of the central banks and the fiscal stimulus that's going on in the West then flowing through in terms of that inflation.
Yeah, absolutely. And your point about the time compression, I think, is really, really interesting, because if you look at it more broadly, there are a whole other set of other indicators that seem to be moving much quicker than previously. In other words, time is compressed, things are happening more quickly, and I guess that may be something to do with the speed of all of the stimulus packages that have been rolled out or pulled in, but also just the fact that the volatility is so strong.
No, I agree, and that's something I've been thinking about for a while now. Just that we've got these cycles now that are driven not by the normal organic, business cycle, that are driven by stimulus, and rather than an expansion cycle being measured in years. I mean, what normal recessions are every 5 to 7 years, depending on the country and what time period you're looking at. But you're now looking at a situation where cycles, in terms of, say, something like retail sales, are lasting maybe 2 or 3 months, and then it's just back down again, and then until the government just throws more money at it.
Well, I did a show earlier on today on the latest credit aggregates, and one of the interesting things there is the money supply has gone up quite significantly again because of all the new liquidity injections that are happening, right? But if you look at it carefully, the correlation between the money supply and anything else is pretty much broken now.
Yeah, no, I absolutely agree. and this is another one talking about the impact of inflation. The conditions for buying major items in the US, things like large household appliances, things like fridges, washing machines, those sorts of large durable goods, cars and houses has dropped in some cases to the lowest level since the late 1970s, and inflation is just absolutely killing the US consumers' desire to spend on these types of items. Now, we are obviously still going to see the benefit of a lot of wealthy people still spending their cash, but in terms of the people on the lower ends of the income ladder, and particularly those are in states that have been more significantly impacted for longer by restrictions and by the virus, things are really not that fantastic. I mean, you still have something like 13 million people claiming unemployment benefits of some variety, and that isn't going away. And as we discussed with the initial jobless claims being worse than expected, it really does make you wonder what if they're still three times what they are normally. What is that number going to look like when all this stimulus finally feeds through the economy? I mean, we've had $2.8 trillion in the last 7 months.
Well, it's interesting because Powell had something to say on the whole question of job rates and employment rates. He said, look, it's quite interesting because we've got a lot of job openings there, but we've also got a lot of people who are unemployed. And he was hypothesizing, well, maybe it's because people need to retrain from one role to another role to get the new job, which would suggest it's temporary. But I wonder whether there's something more structural going on here, actually.
Yeah, I think that it's just a case of a lot of uncertainty, and a lot of things we don't know, and a lot of people making making predictions based on things that we don't entirely understand.
You mean they've got cloudy crystal balls too?
Well, they do, and I mean, I think the difference is that they actually believe in the power of their crystal ball a little bit too much at times. I think, I know that my old magic 8 ball is a magic 8 ball, and I don't put any more stock in it than that.
Good on you.
All right, well, I think that is the last one for today.
Yeah, very interesting. And congratulations on those slides. There were some really, really good ones there. And, I think one of the things to underscore here, Tarric, is that data really is helpful here, right? It really does tell a very, very good story. And that's one of the reasons why we're data rich on this channel, because it sort of puts to bed some of the sort of the waffle that's out there in terms of everything's fine, nothing to see here, The truth is the data doesn't point the same way.
No, it doesn't. And I think one of the slightly frustrating things about all this is that it's really just a case of the writing's on the wall. And I know we've been saying that for a while, but the truth is they just keep throwing more bloody money at things. And there were people in April, May last year talking about how basically this was a never-ending stimulus cycle now. And we're seeing that play out. We're seeing the fact that every time the economy starts to falter, it's like, oh, well, we need to throw another couple of trillion at it. We need to throw more money at it, more money. And I mean, you'd think after throwing, what is it in the US now? About 6-7 trillion now. I've personally lost count, but it's just so much money. And you're talking about something that's like a third of GDP in a period of about 17 months, 16 months, 17 months, and it's a truly insane amount of money. And they've got absolutely bugger all to show for it in terms of, you literally could have, well, I'm not going to go on a long rant about it. I've done that before. But, people know what you could do with $7 trillion. You could literally buy up large swaths of the freaking world, But it's just a bit ridiculous that there's still calls for more and more, because they know that the moment they take the punch bowl away, that shortly after, 6, 12, 18 months after, it's just going to fall flat on its face.
Well, this is a game of Jenga, right? In terms of, they've got all of these supports and, but if you try and take something away, all right, the whole thing is just going to collapse, right? So they've got to keep putting the extra supports in and try and keep the thing shaking, but it's getting taller and taller and more wobbly, right? Which means that the chances of it actually landing smoothly and well is close to zero, which is right back where that Bank of England critique by the House of Lords was so powerful, because they basically said there is no exit strategy for quantitative easing. And that is the question that everybody should be asking all central bankers. Mainstream media, next time you ask a question of Phil Lowe, ask him about the exit strategy, because that's the big question. That's the question that we should be forcing central bankers to address.
Well, there's a very good reason why a lot of politicians and central bankers don't answer questions from people like me.
Because you ask the hard ones.
Well, let's just say I've asked some questions of Gladys Berejiklian in the past, and all I've got is stonewalled, which was loads of fun. Which is, to be completely honest with you, it's not an uncommon response from politicians' offices, to be completely fair. Yeah. But as you say, we're in this situation whereby we're trapped. We're trapped in QE infinity land until either it all blows up or they realise that it's such a horrible idea that they need to stop. And it's kind of, honestly, it's kind of it's not kind of, it is a scary thing, because it's where does it all end? How bad do things get before they finally, just accept things for what they are and just deal with it? And
next time, after the next election, or down the track or something, right? They never want to deal with it today.
No, they don't. And I think one of the most frustrating things about this is that the amount of resources that have been deployed to save markets, to save asset prices, to save property prices, if you had have taken all those resources, because the reality is considering the demographic issues, considering all the different problems that we face, over leveraged consumers, all these different things, we're headed for a pension crisis regardless. We're going to hit that in the next 5 or 10 years at some point regardless anyway. You were going to see that hit states and governments around the world, because basically they don't have the money to pay for the pensions that they promised that they would give boomers. It's not going to happen. You've already seen some cities in the US go bankrupt, some counties, some states are heading that way, places like Illinois, and it was going to happen anyway. But instead of just saying, okay, let's just take the money that we've blown on all this other crap, we could have bailed out the pension system, done what we needed to do to save social stability, but instead we've sent stocks to the moon.
And that's the point, Tarric. This is an ideological stance, right? The point is that decisions were taken, right? People decided to do X, not Y, right? And frankly, a lot of those decisions were taken without, I think, appropriate oversight, nor indeed appropriate review, and yet decisions have been taken, and the consequences are distortion, a one-sided economy, a quantitative easing program that has no way out, and a wasted 20 years or so, frankly.
Pretty much. And one of the things that really gets me about here in Australia is the support that it enjoys from the public. I saw a poll the other day that said that 66% of Australians supported the return of JobKeeper. 66%. After JobKeeper wasted somewhere between, depending on the estimate you go by, somewhere between $20 and $70 billion. And Jesus Christ, we chased a bunch of welfare recipients, and some of whom were disabled, some of whom were pensioners. We chased them mercilessly for $500 million. And here we are blowing up to $70 billion. And what do we have to show for it? There's a bunch of creative tradies who've got nice new jet skis, and they gave the missus a nice new kitchen, and maybe that. And to be honest, I think that'll make a fascinating study for you one day, Martin, to see how much that supported the economy. But for the rest of us who ended up with nothing, who haven't got a cent from the government this entire time, and I might have never expected one. It's a different story.
Well, I interviewed Michael Hudson last year, in fact, on my channel. He's one of the big economists from the US that I found really interesting. And he made the point that the neoliberal ideals that underpin all of this, right, which have contaminated most Western economies, are creating this bigger divergence between the small proportion who have everything and everybody else. And, the debt slaves are required to work harder and faster just to maintain what they've currently got. And his view was that this is something which is so wired into the psychology and economic thinking of central banks and universities and governments and treasuries around the world, particularly in the advanced Western economies. It is so fundamentally wired in that we've just sleptwalked into this without really realizing where we've got to. And I think he's right. His solution was, well, you've got to actually recognize that you can't just sort of drift into an alternative future. There has to be a more radical break if you really want to tackle this.
No, well, I think that that needs to take the form of a political party or a group providing an alternative view of the future of what things should look like. And I mean, I should clarify regarding JobKeeper. It's not that I don't support people getting what they need. Yep. That they're not having the government step in to support people. I absolutely support that. But it needs to be done in a targeted way where not every single person with a creative accountant has been handed tens of thousands, if not hundreds of thousands of dollars. And even if you look at the data, I mean, which I believe you mentioned recently, you're talking about tens of billions of dollars that have been definitively wasted by the government's own definition.
Yep.
I mean, and there's no punishment for that whatsoever.
Correct.
I mean, I don't. You know, I mean, really, what incentive is there not to do it? I mean, I could have literally just said, "Oh, yeah, I'm a sole trader. I've got creative. I've lost my income, and there's absolutely nothing that says I can't get $750 a week for doing my job anyway." And it's just silly.
Yeah, well, I've had a couple of people say to me they've been working with their accountant to cook up an appropriate letter so that they can get hold of it, whether they need it or not, whether they should get it or not. But just going back to, as we sort of come to the end of this thing, you talked about a different political voice. And of course, it's interesting because this last week, the Labour Party basically decided to remove any wish to get rid of negative gearing and have also agreed to support the tax cuts that were already legislated previously. In other words, those two major parties have got closer and closer and closer together on so many things. I wonder whether there's much light between them at all now.
That was pathetic by Albo, to be completely honest with you. The idea that in 2 days you go from supporting additional funding to make sure that cancer patients don't have to pay out of pocket to then giving tax cuts that overwhelmingly benefit people on much higher than median incomes boggles the freaking mind. I mean, what is he thinking? I understand that they had problems with negative gearing, with franking credits, with all this other stuff, and that they want to get elected. But But realistically, aside from we're going to stay closed forever, and we're not going to open up until we have mRNA vaccine manufacturing facilities, what do they stand for at this point?
Yeah.
Now, don't think that this is me just having a swing at Labor. I mean, well, let's be honest. On here, I take more than my fair share of shots at Scott Morrison and the Liberal Party. But what do they realistically stand for? And not only that, but this isn't just people like me who are, sort of in the relative middle of the political spectrum in the grand scheme of things. This is people like, people who are lifelong members of the Labor Party, even MPs, coming out and saying, "What the hell are you doing?" I mean, I don't know if Albo's just going to re-announce everything before the election and cook up something new, but I don't know. And I just find it kind of silly now that Albo's being so responsible with the old Treasury checkbook when at the end of the day we're blowing through more than that in a couple of weeks on this stupid lockdown.
Well, I agree. I have to say that whilst I wasn't totally surprised, I have to agree with you about, so tell me again what they stand for. What is their differentiation? I mean, maybe a bit around climate change if you're lucky, but even there it's a bit watered down and wobbly at the minute. But this is serious stuff, because basically if there is no other choice between neoliberalism 1 and neoliberalism 2, you've got no choice. We're going to have more of the same.
Well, it's my hope that we'll see the rise of a third party and whether that's something that I personally find appealing or not. I mean, obviously that will depend on what form it takes, but just something, to quote the old Australian Democrats, to keep the bastards honest. And that's really what it's about at this point, just something that provides pressure to address these issues that go completely not unnoticed, but unaddressed by the Liberal and the Labor Party. I mean, I think it's quite funny that Albo says to all the cancer patients, no, sorry, we can't afford your treatment. We're not going to be able to pay for that. But I just sold my investment property and I doubled my money. I made $1 million.
I know. Yeah, it doesn't seem quite right. Well, it's interesting. In a couple of weeks' time on my live show on a Tuesday, I've actually got one of those new forming parties to come on, because I want to, explore what it's like to be in that sort of wilderness area of saying we want to try and do something different, because it's not easy to make it work. And so hopefully we'll be able to explore that in a couple of weeks' time. So it'll be interesting to see where that goes. But look, very thoughtful conversation as always, Tarric. I really enjoy our Friday afternoon chats, and I'm very pleased that you managed to get the decorating done last week, so you're able to come on the show this week.
No, I'm quite pleased too, Mike. I always enjoy our chats.
Excellent. Thanks for that. And I'm sure we'll do it again soon. Take care.
Yeah, no worries, mate. I'm looking forward to it.